When a market crashes, it rarely plummets in a single, straight vertical line. Instead, prices tend to step down in a staircase pattern, dropping rapidly, pausing to catch their breath, and then dropping again. This structural pause routinely traps novice investors. They see a brief upward bounce, assume the worst is over, and buy in, only to get caught when the floor falls out a second time. Traders map this specific sequence as a measured move down. This chart shows three parts. First, the first leg's steep decline. Next, the corrective phase's temporary upward rebound. Finally, the second leg drops lower. Framed with trend channels, both straight-line downward legs share the exact same slope. Rounded declines break the pattern. Identifying this specific geometric rhythm allows you to spot a temporary pause in a broader downtrend, keeping you from buying into a falling knife. Not every bounce after a drop is a valid measured move. One of the most common mistakes is confusing a strong rebound off a horizontal support floor with a true corrective phase. This chart illustrates the trap. Notice how the initial sharp drop lands exactly on a flat, pre-existing horizontal baseline around the $40 mark. That strong historical support curtails any meaningful further decline. What looks like a second leg starting is actually just price consolidating horizontally. If you short the stock here expecting another massive drop, the support floor will hold and the price will bounce upward against your position. The second major trap occurs during the bounce itself, specifically when traders misinterpret the upward height of the corrective phase. On this chart, you can observe a massive V-shaped upward bounce following the first decline. The recovery travels extremely high relative to the initial drop. To filter out these false signals, apply a strict mathematical rule. A valid corrective bounce recovers exactly 38 to 62% of the first leg's total drop. Because this bounce aggressively breaks past that 62% threshold, it is no longer a temporary pause. It is highly likely the start of an entirely new upward trend. A reliable measured move down is fragile. You can only trade it safely if the price action completely avoids flat support floors and strictly obeys that 62% retracement limit. To increase the odds of a successful trade, check the volume. Statistically, measured moves that exhibit a distinct U-shape in the volume bars below the price action have a much higher chance of hitting their eventual downward targets. Once you confirm the pattern, you need to calculate exactly how far the second leg will drop to set your take-profit target. We calculate this using the measure rule. This chart displays a massive first leg decline. The standard measure rule formula tells you to calculate the total vertical height of the first leg, and then subtract that exact dollar amount from the highest point of the corrective phase. Look at the values on screen. Pause the video and calculate the target price for the second leg drop. If you ran the numbers, you ended up with a target of negative $9.13. Since a stock price cannot drop below zero, the standard rule breaks down entirely during massive market crashes. To fix this, calculate a straight line first leg drops rapidly, followed by a clean corrective bounce that retraces right to the middle of our 38 to 62% safe zone. You open a short position the moment the corrective phase ends and the second leg turns clearly downward. For strict risk management, you place a stop loss exactly 15 cents above the peak of the corrective phase, relying on that previous high to act as a ceiling of resistance. Using our measure rule, we project the length of the decline downward. Once the price drops and touches that calculated target, you cover your short and exit the trade to lock in the profit. To trade the measured move down, follow these 5 rules. Look for straight line drops, ensure the bounce recovers only 38 to 62%, avoid flat horizontal bases, watch for U-shaped volume, and set your exit target using the measure rule, adapting to the 50% model when necessary. The measured move down helps you map out and capitalize on bearish momentum. But remember that selling short exposes you to theoretically unlimited risk if the price spikes. All trading carries inherent financial danger, and you should always test these strategies in a simulated environment before risking real capital.